All right, let's turn to investment strategy. Lots to consider right now, of course, with a few stock picks as well. Marcus Bogdan joining us from Blackmore Capital in studio. Marcus, terrific to see you. You made the trip from Melbourne again. That's obviously a positive sign that you've been in the air.
Yes.
Planes are in the air.
Yep, still healthy.
For how long though? Because clearly Omicron is becoming of increasing concern. We've seen the reaction in the States, but still a lot unknown, and the science is telling us maybe another couple of weeks before we have some certainty there. What are you considering?
In short, it doesn't change the way that we're viewing markets. There's really three themes that we're focusing on. The first theme is around the pandemic, the disruptions we're seeing in supply chains, the elevated levels of inflation, and that all points to having stocks in the portfolio which are resilient through this whole period. They've got pricing power, they're actually growing both sales and earnings. So that's consumer staples, areas in healthcare, and quality defensive. So that's sort of a real foundation stone in the portfolios. The second area is that just looking at the evidence, first quarter updates and AGMs on the whole have been more positive than expected. And so we're still going to see earnings growth of 10 to 12% for the financial year. And so those companies with good earnings momentum are still incredibly important. And the third area that we're looking at and we've put a little bit more attention into is those areas that have really sold back quite dramatically over the last quarter or so. So companies like BHP, where you've seen the iron ore price come back from over $200 to under 100 and now sort of stabilising that at around these sorts of levels. So that's really in a nutshell of how we're seeing markets at the moment.
Because that was certainly a discussion yesterday, was really differentiating trading from investing. And so you're of course in the latter camp. So you use volatility to your advantage to sort of take profit or add to positions. That's how you can use Omicron nerves.
Yes, so when we do sit, we've got a strong watch list of companies, and we've also got the portfolio companies. And when those companies fall below what we believe is fair value, that's the time that we will add to those companies. But in essence, we want to be long term. We want to have that compounding of earnings and dividends over time.
Okay, of course, it's not just about adding; it's also about taking something out of the portfolio as well. You are reducing your exposure then to the banks. What are you seeing at the moment?
So the banks were absolutely exception in the last reporting season. And profoundly quite disappointing results, notably from CBA. Westpac has obviously been the cheapest bank, but it's had the most sort of structural problems in that bank. But despite having strong growth in mortgages and starting to recovery in business lending, margins are under pressure. We saw a contraction of NIMs of around 10 basis points. And we've seen the persistence of higher expenses. And so all of those things put pressure on forward earnings, put pressure on negative jaws of higher expenses and lower growth. And the banks have had a remarkable run over the last year. They were the greatest component in terms of earnings per share growth for last year. But I think this year you'll see moderation in earnings, and our attention is, whilst we still have a handful of banking exposure because the dividends and the balance sheets are strong, our attention is to other parts of the market.
And of course, with virus and its various mutations, healthcare is as important as ever. I believe you've sat and listened to a whole range of companies. What's your takeaway?
So the key takeaway is the pathology companies continue to do very well. The international group, Sonic, you're seeing very elevated levels of testing in Germany, starting to see higher testing levels in the US. And in Australia, PCR testing is up above 300% from the March quarter. So there is a persistence there in testing, and as we get more of these variants and the potential for long COVID, I think PCR testing will be a core part of their earnings for the foreseeable future. And at the same time, we're seeing the Australian economy reopen and the normalisation in healthcare services. So the base businesses of pathology and imaging are now starting to grow back at normal levels at around 5% per annum. And then you've also got elective surgery coming back, particularly in Australia. So healthcare is an area that we remain positive on. It's an overweight in the portfolio.
Any particular names stand out in the sector?
Well, we still like CSL and the prominence that has in the portfolio. And there is certainly an ongoing and consistent recovery in plasma collections in their largest market in the US, coupled with strong pricing. So that's a cornerstone healthcare stock. And then the pathology companies, Helios, private hospitals in Ramsay Healthcare, and a smaller company called Integral Diagnostics, which is an imaging company, which is also starting to see a recovery in volumes as well.
Okay, you started at the outset there talking about upping your holding of BHP. You've also added Brambles and Endeavour Drinks. Talk us through that.
So we had an update with Endeavour Drinks, and so they come into that staples category, that retail liquor.
That's a sad indictment on Australian lifestyle, isn't it?
It is, but it's very much part of our culture. But
it's a right, that's what it is.
To get out to the pub is a national right.
Absolutely. And so in their retail business, which is BWS primarily and Dan Murphy, there has been a shift to premium products, so they're seeing an uplift of margin there. They've benefited from online delivery, and we think that the base business has still got a range of really good growth options. Their Pinnacle private label business is growing strongly, and we still believe that there's further penetration there. And then the hotels business, which is a smaller component of Endeavour, which is around 20% of earnings. 40% of their hotel fleet was under lockdown, so we'll expect to see a recovery there, particularly in Victoria and in New South Wales. And there is the potential there with a strong property group that there might be a sale and leaseback opportunity for some of the hotels there as well. So very good staple company, but also quite significant growth options there for the company to execute on.
So what are the risks going forward? I mean, we know we're sort of chatting off air, like from a macro perspective, like the Fed's now talking hikes, the Kiwis have hiked, we might hike as well. Does that present any challenges to the portfolio looking into next year?
Oh, absolutely evident that there's challenges everywhere, from a pandemic perspective, from a macroeconomic perspective. And so that's why I think the importance is on quality, on companies that have got leadership, have got pricing power. So if there is a shift of higher interest rates or slower economic growth, and even with higher inflation, companies like Brambles and Amcor have got pass-throughs in their contracts so that they can absorb those higher prices. So if anything, you would just underline leadership and quality to navigate through.
That's right.
Through this period
the blue
of time.
chips actually know what a tightening cycle is.
Yes.
Let's face it.
Yeah, absolutely. Yeah.
Well, and you can throw a federal election into that mix early next year as well. Just something else to consider too. Marcus?
Yes, indeed, and hopefully, that might lead to further spending as well. So.